Here is something that surprises a lot of couples in Australia. One partner turns 67 and thinks, great, we can finally get the age pension. But then they find out their younger partner's income is counted against them, or their savings are assessed together, or their partner's super balance affects the payment. Suddenly it feels like the rules are working against you. But here is the truth. If you understand exactly how these rules work, you can actually plan around them. And today, we are going to walk through every single one. Welcome. If you and your partner are in different stages of retirement, or if only one of you is old enough for the age pension right now, this video is for you. We are going to cover what gets counted, what does not, how deeming works for couples, and what the thresholds look like in 2026. Everything in plain English. This is exactly the kind of content we focus on here at Centrelink Pension Bulletin, because these rules affect real families every single day. Let us start with the most basic question of all. Can you claim the age pension if your partner is younger than 67? Yes, you absolutely can. You can claim the age pension once you turn 67, even if your partner is younger. The age pension age in Australia is 67, and that applies to you individually. Your partner's age does not stop you from applying. But, and this is important, Centrelink will assess your combined income and assets when means testing your pension. Your partner's income and assets are included in the calculation. So while you are the one receiving the payment, your partner's financial situation still matters. Their savings count, their income counts, their investments count. Centrelink looks at the household picture, not just the individual who is claiming. Now, here is the part that gets interesting, and this surprises a lot of people. Super in accumulation is not counted while its owner is under age pension age, and that applies to your partner's super too. Read that again slowly. If your partner is under 67 and their superannuation is still in the accumulation phase, meaning they have not started drawing it as an income stream, that super balance does not count as an assessable asset for your pension claim. Think about what that means in practice. If your partner has $600,000 in their super account and they are under 67, that $600,000 is not counted in your assets test assessment at all. It is as if it does not exist from Centrelink's perspective. That is a significant exemption, and it is one that many couples never realise is available to them. So let us now look at the asset test thresholds for 2026, because these are the numbers you need to know. From 1st July 2026, a single homeowner can have up to $333,000 for the full rate pension, and below $733,500 for a part pension under the general assets test. For couples, the numbers are different. Under the assets test, your pension reduces by $3 per fortnight for every $1,000 of assets above the threshold, which is $499,000 for couple homeowners. And importantly, for couples with one partner eligible for the pension, the combined assets threshold is up to $481,500 for homeowners or $739,500 for non-homeowners before the part pension begins to cut off. Your home itself does not count. Your principal home is excluded from the assets test. So these limits apply to everything else: savings accounts, cars, furniture, shares, managed funds, and superannuation if it is assessable. Now here is something worth pausing on. When you are a couple with one partner over 67 and one partner under 67, Centrelink does not treat you as a single. The eligible partner does not receive the single rate merely because the other partner is under 67. The eligible person generally receives the relevant partnered rate, while the couple's combined assessable income and assets are used in the means test. So you get the couple's threshold, which is higher than a single person's threshold, but you also get assessed as a couple. The rules work in both directions. Let us now talk about deeming, because this is where couples often get the most confused. Deeming is the system Centrelink uses to calculate income from your financial assets, your bank savings, term deposits, shares, and managed funds. Rather than looking at what those assets actually earned, Centrelink assumes they earned a set rate. That assumed rate is what affects your income test. As of March 20th, 2026, The lower deeming rate is 1.25% and the higher rate is 3.25%, applied to assets above set thresholds that differ for singles and couples. For couples specifically, the first $110,600 combined is deemed at the lower 1.25% rate. Anything above that is deemed at 3.25%. That $110,600 is combined. It is not $110,600 each. It is your joint financial assets pooled together and then split across those two tiers. Let us walk through a practical example to make this real. Say you and your partner have $200,000 in combined savings and term deposits. The first $110,600 is deemed at 1.25%. That equals $1,382 per year. The remaining $89,400 is deemed at 3.25%. That equals $2,905 per year. Your total deemed income for the year is $4,287, or about $165 per fortnight. That is what Centrelink counts in your income test. Compare that to what your bank might actually be paying. If your savings are earning 4.5% in interest, your actual earnings on $200,000 would be $9,000 per year. But Centrelink only counts $4,287. You are being assessed on less than half of what you actually earned. That is a meaningful benefit for couples with savings in a higher interest rate environment. Now, here is something worth thinking about. From 1st July 2026, while the deeming rates themselves stayed the same, the threshold dividing the two brackets increased by $4,400 for couples, rising to $110,600 combined. This means more of your savings are now assessed at the gentler 1.25% rate. Your deemed income went down slightly, which means your pension could be a little higher than it was before July. That is a quiet improvement that many couples did not even notice. Now let us address the income test directly, because deeming feeds straight into it. A couple can earn up to $396 combined per fortnight before the pension starts to reduce by 50 cents per dollar over the limit for each person. So if your combined deemed income from savings, plus any other assessable income, rental income, part-time wages, overseas income, stays under $396 per fortnight combined, your pension is not reduced by the income test. And if your partner is still working, that income counts too. If you have a partner, their income will also be included in your income test assessment. This is a detail that catches people off guard. If your partner is 60 years old and working full-time, their wages are included in the household income assessment for your pension. A higher income from the younger partner can reduce, or in some cases eliminate, the older partner's pension entitlement under the income test. But it is not all bad news. If you are still working, the work bonus allows you to earn up to $300 per fortnight from gainful employment without it counting toward your income test. And unused amounts accumulate in a buffer up to $11,800. So even part-time work does not necessarily hit your pension as hard as you might expect. Now, let us talk about something that is genuinely useful for couples in this situation: the superannuation exemption. We touched on this earlier, but let us go deeper. If your partner is under 67 and is not yet retired, Centrelink will not count their super as part of your combined assets. That is a powerful exemption. However, there is an important catch.
If your partner withdraws some of their super, it will be counted as part of your assets, and this may impact your age pension. So, if your younger partner starts withdrawing from their super fund while still under 67, those funds become assessable. They move from a protected bucket into an ordinary financial asset like a bank account, and are then subject to both the assets test and deeming. This is why timing matters so much. For couples with an age gap, directing as much wealth as possible into the younger partner's superannuation in the years leading up to the older partner's pension eligibility significantly reduces assessable assets and improves pension entitlement.
The exemption ends when the younger partner turns 67. At that point, their super becomes fully assessable. Planning around this window can make a real difference to your retirement income. And here is one more thing on this topic that many couples do not know. If your partner starts an account-based pension, meaning they convert their super into a regular income stream, different rules may apply. If your partner has an account-based pension, this will count towards your assessment even if they have not turned 67 yet. So, simply being under 67 does not protect all types of super. It specifically protects super in the accumulation phase. Once it becomes an income stream, it is counted.
That is a detail worth knowing before making any super decisions. Now let us bring this all together with a simple summary. If you are 67 or over and your partner is younger, you can claim the age pension in your own right. You will be assessed as a couple, not a single. That means you get the higher couples thresholds, but your partner's income and assets are included in the assessment. As a couple homeowner, your combined assessable assets need to be under $499,000 for the full pension, and you can hold up to $1,102,500 combined before the part pension cuts off entirely. For Deeming, the first $110,600 of your combined financial assets is assessed at 1.25%, and anything above that at 3.25%. That deemed income feeds into your income test. Your partner's super in accumulation is not counted while they are under 67, but the moment they withdraw it or start an income stream, it becomes assessable. And your partner's income from work is included in the household assessment, but the work bonus helps reduce the impact for pensioners who are still earning. The rules are complex, but they are not impossible to understand. And once you understand them, you can make much smarter decisions about how your retirement savings are structured. If any of this has raised questions about your own situation, I encourage you to contact Services Australia directly or speak with a financial advisor who specialises in retirement planning. A proper assessment of your specific circumstances is always the best starting point. If this video helped you understand these rules a little better, please give it a thumbs up. It helps other Australians find this information when they need it. And drop your question in the comments below. I read every one, and your question may well become the topic of our next video. If you are not yet subscribed to Centrelink Pension Bulletin, please do it now. We keep our videos simple, current, and practical because this is your retirement and you deserve clear answers. Coming up next, we are looking at what happens to your age pension if you go overseas, even for just a short holiday. The rules are not what most people expect, and a simple trip abroad can affect your payments in ways you would never have guessed. You will not want to miss it. Take care of yourself, and we will see you in the next one.